Okay, so you've probably got a good handle on the daily pulse of your business,
Mm-hmm.
right?
Mm-hmm.
Revenue's up there, you're watching those margins like a hawk, and profit. Oh, well, that's the score you check all the time.
Sure, the operational stuff.
Exactly. But let's just zoom out a bit. What about the actual overall worth of the whole thing, your business valuation?
Yeah, that number, it sometimes gets a bit lost, doesn't it?
It really does. And yet, it's so critical, which is exactly what we're diving into today. We're looking at Daryl Amy's piece, What Gets Measured Gets Managed, Why You Must Measure Business Valuation.
Ah, yes. That article really nails a key idea, echoing Peter Drucker.
The classic, what gets measured gets managed.
Precisely. We use that for sales, for marketing, operations, but like the article asks, why does business valuation often get left out? It's a really important question.
It is. And think about it. If you aren't actually tracking what your business is worth, I mean, can you really manage it effectively for the long haul?
It's like trying to navigate without knowing where you're actually going.
Yeah. You might be moving, but are you heading towards the most valuable destination?
And Amy points out how strange it is. So many owners know their metrics inside out, MRR, CC, you name it.
Oh, yeah. Down to the decimal point sometimes.
Right. But then ask about enterprise value, the overall worth. And often there's this gap.
And the article calls this a massive problem, which, when you think about what's riding on it, it's hard to argue.
Definitely not just a number.
No, it's tied directly to, your personal freedom, your options down the line, your legacy even. These are big things.
Huge things. And that's why just waiting until you think you might sell to figure out the value, that's risky.
Really risky.
You could get a nasty shock with a low valuation right when you weren't expecting it.
Or miss a great opportunity.
Exactly. Miss strategic sale chances. Or, as Amy says, just leave actual wealth behind because you weren't paying attention.
Okay, but here's a key takeaway from the piece, I think. Business valuation isn't some, dark art only finance wizards understand.
No, not at all.
It's a metric, like revenue, like profit. And crucially, it's one you can actually influence and should be tracking.
Yeah, and the basic formula provided is pretty clear. Value, EBITDA times a multiple.
Okay, let's break that down. EBITDA.
Right, EBITDA. The article explains it basically reflects the real cash flow your business generates, your core operating profit, essentially.
The engine room's output and the multiple.
Ah, the multiple. That's about perception, isn't it? How the market sees the quality of your business.
Quality meaning.
Meaning how attractive it is, how smoothly it runs, how much risk is involved. Basically, how desirable and stable it looks to an outsider, like a buyer.
Okay, attractiveness, readiness, risk.
Yeah.
That makes sense.
And here's the kicker, right? Both parts, the EBITDA and the multiple, they're directly linked to how well you run the business day to day.
So it's not just external forces.
Not entirely, no. Your decisions, your operations.
Yeah.
They shape both those numbers. So valuation isn't just something that happens to you. You have leverage.
So if you build strong recurring revenue, that probably helps the multiple.
Absolutely. That signals stability, predictability, less risk. So yeah, potentially a higher multiple compared to a business with lumpy, unpredictable sales.
The article mentioned something we hear a lot, that sort of regret.
Oh, yeah.
Former owners saying, gosh, I wish I'd spent more time getting ready, preparing the business.
It's a common refrain. And it highlights that thinking about long-term value shouldn't be something you put off.
Especially when you see the stats. What is it? Over half of business exits aren't planned.
That's right. Over 50% things happen. Health, death, divorce, disagreements, life, basically.
So if you haven't been working on the value, you could be forced to sell or transition at a really bad time, or for a lower value.
Precisely. You might have to accept an outcome that's far from ideal simply because you weren't prepared.
And that UBS research finding really drives it home.
Yeah.
81% of owners who sold wished they'd done more prep. 81%.
That's a huge number. Speaks volumes.
So, okay, the obvious question then is, how do you actually do that?
Yeah.
How do you move from just knowing valuation is important to actively managing it?
Well, that's where Amy's value creation engines framework comes in. It's a clear three-phase approach.
Okay, phase one.
Phase one is measure. Simple enough, but critical. Get a really clear, accurate picture of where you stand now, your current valuation.
And not just the current value.
Right. Also understand your potential. What could it be best in class? This becomes your baseline, your kind of strategic dashboard for growing value.
So knowing your current multiple versus the industry average, that gives you a target.
Exactly. It highlights the gaps immediately.
Okay, so you measure first, then what?
Then you accelerate. This is
Yeah.
where you actively work on closing those gaps using what the framework calls the 4 value creation engines:
Which are?
revenue growth, process optimization, culture development, and strategic innovation. These are the levers you pull.
Levers that affect both profit and the multiple.
That's the idea. Focusing effort here should boost your EBITDA and improve that market perception, that multiple. For instance, under process optimization, maybe streamlining your supply chain cuts costs. Boom, higher EBITDA.
Makes sense. And the final stage, it's got a funny name.
Huh, yeah. Exit, expand, or extend.
Okay, unpack that one.
It just means that by constantly measuring and actively managing value, you give yourself choices, real options.
Regardless of the end goal.
Exactly. Whether you want to sell eventually or maybe buy other companies or pass it on, knowing your value gives you control and leverage in any of those scenarios.
So the core message really is start measuring.
That's the fundamental takeaway Amy drives home. If you want to manage your business to value, you absolutely must begin by measuring it.
Otherwise, you're just guessing.
You're flying blind, yeah. And that, as we've seen, can lead to some really unpleasant surprises when it's time for a transition.
For anyone listening who's thinking, okay, I need to do this, the article points towards measure.valuecreationengines.com.
Right. They apparently offer ways to get a market-based valuation, one that shows current value, potential value, and, importantly, what might be holding you back.
The obstacles.
Yeah. Identifying those roadblocks is key.
And it's not just a one-and-done thing, is it?
Definitely not. The article really emphasizes making this a habit. Update the valuation regularly, quarterly is suggested.
Treat it like a North Star.
Exactly, a North Star for the business. It keeps your decisions aligned with where you ultimately want to go, the future you're trying to build.
So wrapping this up then, measuring your business valuation isn't just for the exit strategy planning committee.
Not at all.
It's fundamental to good management day in, day out. It gives you control over today and shapes tomorrow.
Absolutely. It puts you in the driver's seat regarding your business's future potential.
And maybe a final thought, building on that North Star idea.
Just consider, how might things change if you consistently tracked that valuation number, watched it move based on what you do? How might that shift your daily focus, your big strategic bets, guiding you closer to the business and maybe the future you actually want?